I'm John Rutledge, Chief Strategist at Safanad. Welcome to our first podcast, The History of Asset First Economics. I hope you enjoy.
Welcome to the Deep Dive. Today we're tackling a huge paradox in modern finance.
A really big one.
Yeah, why do the standard economic frameworks we all rely on, the ones looking at GDP, employment, output, why do they so consistently fail to predict these massive, violent financial crises that just, blow up the whole system?
It feels like they're looking at all the right data, but maybe through the wrong lens.
Exactly.
They're completely focused on the economy's income statement, the flow of funds over a year. But the real danger, the real leverage, is sitting right there on the balance sheet.
It's like counting ripples in a bathtub and ignoring the ocean's tectonic plates shifting underneath.
That's a great way to put it.
And that is the absolute core of our deep dive today,
Yeah.
the asset-first economics framework. This is a system that's been developed over, 4 decades by Dr. John Rutledge.
Who's the chief strategist at Safanad, yeah.
And his published work connects the dots between inflation, budget deficits, and interest rates. But he does it by using tools from physics.
Right. Things like thermodynamics and complex adaptive systems, it's a totally different approach.
So our mission today is to show you how this framework can actually transform crisis prediction from just a guessing game into something like a quantifiable map.
And we'll use the subprime debt crisis as a case study to really show its power for investors who are trying to navigate these incredibly volatile markets.
Okay, let's unpack this. Let's start at the beginning with this huge shift in focus, because it all started with a direct challenge to the consensus view back in the early 1980s.
Oh, that era was, it was brutal. You had runaway inflation and you had the Fed chair, Paul Volcker, with these punishingly high interest rates.
And everyone thought they were here to stay.
Everyone. The prevailing wisdom from the flow of funds economists, people like Henry Kaufman, they called him Dr. Doom.
Right.
Their logic was simple. The federal budget deficits were massive, and they required more savings than the economy had. So borrowing costs, interest rates had to stay high indefinitely.
But Rutledge published this legendary counterargument in 1981. He predicted the exact opposite.
He did. It was titled, Why Interest Rates Will Fall in 1982.
So how did he see that when all the flow models were just screaming more pain?
It was a fundamental change in geometry, really. The traditional models were only looking at the flow, the $20 trillion or so of annual GDP.
The income statement.
Exactly. Rutledge focused on the stock. The economy's entire balance sheet, which was, even then, something like $400 trillion.
Wow.
The core idea is that asset markets, driven by investor decisions, by leverage, they're just orders of magnitude larger and more powerful than the annual flow of production. If you want to predict a collapse, you should be watching the market with the trillions, not the one with the annual output of goods.
So what's actually in that huge $400 trillion balance sheet that GDP just completely misses?
Well, it's the structure of prices, for one, and it's the enormous, existing layers of debt and credit. That includes off-balance sheet leverage, derivatives, all of it.
Things GDP doesn't even measure.
Not at all. GDP just measures new spending. The asset side measures existing wealth, capital, and most importantly, the potential for these sudden, violent shifts in investor confidence and capital allocation. Most crises are, fundamentally, crises of the balance sheet.
And that gets us to the surprising reason why rates actually fell. Because the deficits were still huge.
They were. The mechanism was capital allocation. In the 70s, investors were terrified of inflation, so capital fled stocks and bonds and piled into tangible assets.
Gold, houses, commodities.
Exactly. When Volcker tightened credit discipline in the early 80s, it forced a massive reallocation. Investors suddenly realized, hey, financial assets are attractive again.
So all that capital came flooding back.
A huge shift of capital back into financial markets. That dramatically increased the supply of credit, and that's what drove interest rates and inflation down, proving the asset-first prediction right.
So the federal deficit, the thing everyone was panicking about, it was almost a sideshow.
It really was. I mean, when the framework looked at the 1983 deficit debate, the conclusion was that a $100 billion deficit is mathematically tiny compared to over $20 trillion in private assets.
So the question isn't, can we finance it?
No, The markets are plenty big enough for that. The real question is, how does that borrowing shift the structure of asset prices? And later evidence showed that $100 billion in government borrowing only raised rates by about 60 basis points.
Nowhere near the catastrophe the doomsayers were predicting.
Not even close. It just showed that these big asset allocation decisions are the real engine of what happens in the macroeconomy.
Here's where it gets really interesting. Because once you accept that asset markets are the key, you have to throw out the whole idea of smooth, gradual change.
Right.
If these markets are so much larger, how do they suddenly break? Is it a slow erosion, or is it instant?
The failure is often instant. And that's why this approach is such a profound departure from standard equilibrium economics. It sees the economy not as a machine that's always seeking balance, but as a complex, adaptive system that's operating far from equilibrium.
Okay, now we're moving into physics. You mentioned things like non-equilibrium thermodynamics net and self-organized criticality. For someone who isn't a physicist, what does far from equilibrium actually look like on Main Street?
Think of it like this. General equilibrium economics sees the economy as a perfectly balanced scale. You add a little weight, it adjusts slowly, smoothly.
It finds a new balance.
Right. But far from equilibrium systems, they build up huge amounts of internal stress until they hit a tipping point. The best analogy is a giant sand pile. You keep dropping single grains of sand on it, most of them do nothing, but then one single grain triggers a sudden, catastrophic avalanche.
The stress was building up invisibly the whole time.
Exactly.
So a financial crisis isn't a gentle recession, it's an avalanche. It's a phase transition.
Precisely. A phase transition is a sudden, dramatic transformation of energy. A crisis isn't a cycle. It's a non-linear event, driven by all this stored-up financial leverage and stress. It's like an earthquake or a hurricane, sudden, violent, and it releases energy in a way economists just weren't factoring in.
And the key mechanism for that phase transition is what you call network failure.
That's it. A financial crisis is basically a temporary network blackout. It's a cascading failure where the transmission of information, and more importantly, trust, just breaks down.
Which leads the framework to distinguish between two completely different states of the economy.
Yes, not just shades of recession, two distinct states.
State one is the good place, right? That's where we want to be.
Yeah. State one is potential output, or general equilibrium. In this state, markets are working, prices are efficiently sending signals. This is Hayek's view of the market as a giant information processor, and capital moves based on those price signals.
And then there's state two, the moment of crisis.
State two is failed network output. This is when financial markets just cease to function. People stop trusting the price signals. They freeze. And crucially, this leads to something called non-price credit rationing.
Okay, wait, let's stop on that term. Non-price credit rationing. We get normal rationing, the interest rate goes up, fewer people can afford a loan. What does non-price mean?
It means that credit is unavailable at any price. It doesn't matter how creditworthy you are or what rate you're willing to pay.
So even a great company can't get a loan.
Imagine you're a blue-chip corporation, you're flush with cash, but you need a short-term loan for payroll. In state two, the network has failed. Banks won't trust anyone. They're not worried about the rate of return on their money. They're worried about the return of their money.
They just hoard cash.
They hoard cash. And the cost of capital skyrockets for everyone. Even if the posted rates you see in the paper look normal, the lights have just gone out on the information network. Nobody knows who's solvent anymore.
That distinction, the systemic collapse of trust, is absolutely critical. And if the economy can flip between these two states, then investment success really just depends on identifying those transition points.
Exactly.
So let's apply this map to the subprime debt crisis.
It's the perfect timeline. It lays out the 4 predictable stages of a phase transition crisis beautifully.
So stage one, full employment. Let's set the scene. Early 2007.
The economy looks great. It's robust. Growth is solid. Profits are up. But this is the classic Minsky moment, where good times breed complacency, you have weakening credit discipline, tons of leverage, and just excessive optimism in the asset markets.
So what does a smart investor do then?
This is a time to get defensive. Reduce your leverage, sell some overvalued assets, and, this is the most important part, build a big stockpile of cash.
And then we hit the trigger. Point A, stage two begins. This is the crisis, the phase transition itself.
Stage two is that violent, short-lived meltdown. It might only last days or weeks. Think about the chaos around the Lehman Brothers collapse.
That's the switch flip.
That's the moment the system switches from state one, equilibrium, to state two, failed network. Returns on pretty much all risk assets are uniformly negative. The fear is just palpable.
And if you didn't raise cash in stage 1,
It's too late. It is way too late to sell at anything approaching a reasonable price. For those who are sitting on cash, the only move is to be patient. Watch and wait.
which brings us to stage 3, the recession and cleanup phase. This is after the acute panic starts to fade.
Right. This is the heavy lifting part between points B and C. The credit markets are still basically closed. And investors who weren't prepared are now forced to sell high-quality assets at distressed prices just to cover their debts.
The fire sale.
It's a massive fire sale, and it creates these extraordinary opportunities. While stocks and bonds start to stabilize, the real alpha is found here.
And the data from that time shows this pretty clearly. Which asset class did the best right after the crash?
Real estate, specifically distressed credit opportunities within real estate. While bonds and equities start to post some good initial returns as the dust settles, property that you can buy during this forced liquidation period, it offers just spectacular potential gains for anyone who has the capital to buy those assets.
And finally, stage 4, the recovery and network regrowth.
Stage 4, from point C to D, is that slow, steady climb back to full employment. The financial network starts opening up to borrowers again, cash flows get better, asset values start to climb.
And this is where those earlier investments really pay off.
Massively. I mean, looking back at the subprime recovery, the cumulative gains were stunning. Hospitality real estate saw 322% returns. Industrial, 272%. Multifamily, 173%.
So the lesson on timing is crystal clear. If you bought real estate early in stage 3 at the bottom of that fire sale, and then sold at the peak of stage 4's recovery, the returns were just exceptional.
They really were. The framework shows that investors who deployed their capital in stages 3 and 4 saw their assets grow by up to 8.9 times their initial investment across different real estate sectors. Hospitality specifically returned 15 times the initial capital.
It just reinforces that it's the network dynamic, not the smooth GDP flow. That's the ultimate source of that alpha.
Got it down.
So if we fast forward to today, what are the investment implications? The framework would suggest maybe a portfolio shift based on higher inflation and potentially higher tax rates coming.
That's exactly right. The capital shift will be structural. You're going to see investors moving away from long-duration financial assets, things like long-term bonds and high-multiple stocks, and moving strongly towards real assets and property.
Because of the inflation hedge?
The perceived safety in the inflation hedging properties, yes. The asset-first dynamic suggests that there could be substantial capital gains for the owners of tangible property.
And you've even applied this complex systems angle directly to real estate by looking at urban resilience. That's a fascinating connection.
It is. Cities are complex adaptive systems, and they exhibit what are called scaling laws. Specifically, superlinear scaling.
Meaning what?
It means when you double the size of a city, things like productivity, wealth, and innovation, they don't just double, they increase by about 15% more than that.
So that's why big, dense cities have such a durable economic advantage.
Correct. And that same resilience helps predict how they recover from shocks. Historically, successful cities, think New York or San Jose, have shown this resilience time and again, even after pandemics or huge social changes.
So the COVID exodus.
The COVID exodus was, in many ways, a luxury good. It was something accessible mostly to high-income families who could afford to leave. But the underlying economic engine of that successful urban core ensures it's going to recover faster and continue to dominate.
So the investment takeaway is to focus on urban property in those historically successful cities. You trust the system dynamics over the short-term trends.
It argues for capital flowing back to the centers of innovation, yeah. But none of this works unless you have the capital ready to go when the opportunity shows up. Which brings us all the way back to the true value of cash in this two-state world.
Right, because cash usually feels like you're in the penalty box. It yields almost nothing during the good times. Why is it so valuable when the network fails?
Because cash holds an embedded real option. You can't just look at the money market rate. The true expected return of holding cash is that rate, plus the value of the option to deploy that scarce capital at fire sale prices when the financial network completely seizes up.
So it's not just low-yield storage. It's a call option on disruption.
That's it, exactly. When everyone else is leveraged up and forced to sell at depressed prices because of credit rationing, the scarcity of your cash makes its purchasing power skyrocket. It delivers an effective return that is far, far greater than its coupon yield.
And the discipline to hold that cash in stage 1 and stage 2 is the foundation of the whole strategy.
Just everything.
So what we've really unpacked today is how asset-first economics gives you a critical timing mechanism. It shifts your focus from the flow accounts to the volatile balance sheet. And by seeing financial crises as these violent, nonlinear phase transitions governed by energy and network failures, it offers investors a clear, four-stage map for navigating both the destruction and the recovery.
If we connect this to the bigger picture, the single most important factor for your investment success isn't forecasting GDP growth. It's understanding which state the financial network is in right now. Is it in state 1, a functioning equilibrium, or is it in state 2, network failure?
And that distinction tells you everything.
It tells you whether you should be reducing your leverage and building cash or aggressively deploying capital into distressed assets.
I think the ultimate lesson from this framework might just be that our traditional market assumptions, of a smooth price-clearing equilibrium, are just dangerously naive. The investor who has the discipline and the capital to wait for the network to seize up and can then step in when everyone else is paralyzed by fear, that investor holds the ultimate non-price leverage.
Thank you for listening to this summary of the Asset First Economics Framework. You can learn more about these ideas at our website, www.safanad.com, or at my blog, drjohnrutledge.substack.com. Thank you.